And let's go to talk about the markets. And Asian shares, they found some calm today following the week's heavy China-driven losses. While the dollar sat at a more than one-year high against major peers, upheld by lingering safe haven demand and expectations for tighter U.S. monetary policy. MSCI's broadest index of Asia-Pacific shares outside Japan dropped 0.06%, while Nikkei lost 0.36%. Worries about economic growth in China due to worsening power crunch combined with fears of global slowdown hitting Asian shares yesterday. However, dollar index that measures U.S. currency against 6 major currencies hit its strongest level in nearly 18 months against yen and in 14 months against euro. To talk more on this, we are joined by Mr. Ilya Spivak, Head of Greater Asia Daily FX from US. Welcome to WION. My first question to you, overall, we can say APAC stock markets are steadying now after much they have seen. What's your outlook on global stock markets? How do you see they going up in the coming few days or going down, or is it a bubble at all?
Very good to be here. I think at this stage what we're seeing is a bit of a respite. We've had obviously several days of very aggressive selling and we're apparently looking at a bit of digestion here. I don't think the main narrative that was behind the move lower has been unwound. That, of course, was the rise in bond yields, reflecting expectations of a tighter U.S. monetary policy and perhaps a sooner path to raising rates from the Fed. I think that is a narrative that continues as inflationary pressures continue. So although we might get a bit of relief here in the next day or two, perhaps linked with the U.S. passing a resolution that would avert a government shutdown and at least temporarily resolve the debt ceiling issue that looms, and perhaps even the passage of a $1 trillion infrastructure bill. That might be a bit of a tailwind as well, but that larger Fed narrative remains, and after perhaps a bit of digestion or maybe even a shallow bounce, I would expect sellers to return to the market and control momentum.
And talking about, since you're in US, and debt ceiling standoff is another crisis, well, the US is facing and the whole world could face as well. How likely is it that this could spiral into a bigger crisis from here on?
Very unlikely, I think, because I think the important thing to remember here is that the debt ceiling in the U.S. is self-imposed. There is no default that I can see in the U.S. unless global creditors stop lending to the U.S., and that is not at issue here. The question is not whether the U.S. is credit worthy. There is no question as to that score, and of course, every global economy is functionally bought into the U.S. dollar as a medium of exchange, and so almost no economy, save for maybe one or two that are completely disconnected from the global financial system, depend on there being a stable U.S. dollar as a medium of exchange for global commerce. So I don't think there is a tremendous crisis risk here because, again, it is not as if the U.S. has been deemed less creditworthy by the markets. This is a self-imposed restriction. If we were to hit the debt ceiling, there may be a bit of a fiscal headwind in that spending would be delayed, but that looks to have been averted here already. The Senate majority leader announcing here just in the past several hours that a deal has been struck and we're likely to get a vote on it when Congress returns to session tomorrow morning.
And what about the post-corona economic recovery? Well, it has been slowing down since May, and now there are headwinds of global inflation as well. What's your outlook on recovery as far as the global coronavirus pandemic and economic recovery is concerned?
So it looks like the overshoot of growth following the pandemic has eased. We've seen growth retreating back from very elevated levels that were peaking around May. We are now back to right around the levels for global growth overall that were prevailing ahead of the COVID-19 outbreak. I think the risk here is that we actually moderate further lower because the inflationary pressure that we're seeing is already starting to undermine demand. Obviously, the energy shortage in China is one aspect of this. In fact, the strong reliance on energy imports outside of the U.S. in Europe, in Asia, that presents an important headwind. Deglobalization, the tensions that we're seeing around global supply chains, that remains a risk. And of course, we're already seeing, for example, just in the past 24 hours, we saw U.S. consumer data where inflation is starting to discourage consumption, where people are starting to expect to pay a higher cost of living down the road as inflation accelerates, and that is undermining their consumption today. Those, I think, are important headwinds. Higher borrowing costs from the Fed, another headwind. So my concern is that we might actually be entering into a bit of a soft patch on global growth here.
Mr. Spivak, one last question on Evergrande, clearly something we can't ignore. But China is trying to show that to the world that it is something which is not a big concern. What's your estimate of Evergrande crisis? Is it bigger than any other crisis China has seen? What about the comparison with Lehman crisis as well?
I don't think the comparisons with the Lehman crisis are necessarily appropriate because the scope for contagion is a bit different. China is a little bit more isolated in terms of capital flows, and the authorities have a bit more control in terms of cutting off the vectors for contagion. It is nevertheless a very significant issue. We've seen that credit spreads in China have widened out to the biggest since 2011. So clearly, this is a very significant source of potential risk. At this moment, it looks like the PBOC's liquidity injections are having an effect, and the markets are not quite prepared to panic because even if certain bond payments are missed, there's a 30-day grace period there, which has not elapsed and seems to have only just started for this latest payment that we're still waiting to see in the coming days here. So I think at this point, it isn't an immediately burning fire, but it is certainly something to keep a very close eye on. There are a lot of global funds and assets that include in them underlying exposure to China. So even if we were to see a relatively localized decline in China, it might still spill over into global assets and depending on the severity, be a trigger for asset sales and something of a market rout. So that's something certainly to keep an eye on.
Thank you, Mr. Spivak, for talking to us and getting us all this important perspective on all these developments. Thank you once again. And
my pleasure.
Moving on, WION now available in your country. Download the app and get all the news on the move.